All right, that beep on Brian's computer was likely the sign that it is 1 o'clock. Let's get started. Thank you for joining us. My name is Matt Patten. I'm the CEO here at Cutler Investment Group, and we are excited to once again present our market outlook with Erich Patten, our CIO, and Bryan Knutson, Senior Wealth Manager. If you've joined us before, you know you're in for as much excitement as we can bring to the bond market and maybe a little bit on asset allocations as well. In addition, this will be recorded, so if you want to go back, review any of it, ask your advisor any questions you may have, it will be posted later today to our website, and we encourage you to share it with anybody that might have some of the same questions that you do. With, I guess, last final point is you might want to hit in your top right corner the speaker view button so that you have the speaker in front of you instead of having the opportunity to look at both Bryan and I throughout the conversation. And the Q&A will be open at the bottom. If you'd like to ask a question that we can feed to the panelists, feel free to type it into the bottom at the Q&A. And with that, we'll get started. Good afternoon, gentlemen. You ready?
All right. Thank you, Matt. We've got a lot to talk about today, so let's jump right in. We've called this market update, "The Recovery Continues. Will inflation follow?" And that is the big question that a lot of investors are asking today, and then we're going to be asking that as well as we march through this. But we're going to start with what I would call the normalization conversation, talking about how the economy is reopening and what that looks like. Then we're going to move into policy, talk about Fed policy as well as the federal government policy. And then we're going to end with a discussion on specific asset classes, the bond market, the equity markets, and in our view, to kind of wrap things up. So let's start, as we always do, with some disclosures. I'll move on to the next slide here. What I'd like to point out is we are giving this presentation on April 15th. Normally, we would all be focused on our taxes today, but fortunately, we had a 1-month reprieve this year, but new information does become available, and at Cutler, we will adjust our views accordingly. So if you're watching this sometime in the future, the views that we express today may or may not be relevant at that future date. All right, so let's talk about normalization. And a lot of this is a recap of what we all know, what we all sense, what we're seeing out there in the economy. But the US has done a great job of our vaccine rollout. Really on the developed countries around the world, only behind the UK, which has really taken a 1-dose policy as opposed to the 2-dose policy here at home. But we've seen the rollout really have a strong impact on deaths. Already in the United States, we've seen deaths drop pretty dramatically. The new cases and kind of the new wave have generally been a younger population with less lethal results. And what that has really done domestically is create an amazing amount of optimism. That optimism is flowing through to economic growth. And we're seeing it. We're going to talk about different sectors. We're going to talk about different industries today. But this is a summary slide that really shows what is happening on the global economy. And it's like nothing we've seen really for 50 years. The US is expected to have over a 6% GDP growth this year. We haven't had 6% GDP growth really since the late 1970s. So it is a time of, you could think of it maybe as the roaring 20s all over again. We have some incredible growth ahead of us. Investors are optimistic, businesses are optimistic, and consumers are optimistic. So let's talk a little bit more about consumers and specifically jobs. Bryan, how do you feel about the job market? What have we seen over the last year as we had that initial big drop in unemployment and then the climb back? Are we all the way there yet, or we still have a ways to go?
Hello, everybody. Thanks, Eric. We do still have a ways to go, but the encouraging news is we are making up ground faster now than we have for the last few months. So what we see on the left-hand side here, it took 10 years to create just under 23 million jobs. It took about a month and a half, really a month and a half, and then a few lingering after that, to lose about 22 million jobs. Many of those were people on pause, and we know that they wanted to come back to what they were doing before. Many of them already have. Some of them maybe will have to do some adjustments. We'll talk a bit more about that. But what do we see here? If I take the 22 million lost, about 13 million gained, That gives me a net of about 9.5. Over on the right-hand side, where are those jobs still out there to be filled? About 40% of them are in the service-related industry. That's that big empty gap there on the left-hand side. What is it going to take for those to come back? It's going to be very state-specific. You're going to get a lot of that coming back from the biggest states, like, for example, California. About 1 out of every 8 people in this country is in California. And that state is further behind in their reopening measures than some others, but we are starting to see big numbers come back. Right when we started to see reopening, we were gaining back millions of jobs. Then it slowed down. We had sort of a pause. We had a deep breath and a look around. This month, the number that we got was about 900,000. This month, looking forward, and then the month after that, it's very possible to get 1 million plus for both of those months. We can close that gap. We're at about 6% unemployment, down from about 15. Previous to the pandemic situation, the lockdown situation, we were at about 4% unemployment. Getting back there will still take some time, but we could definitely see a number in the 5s here very soon and then take it from there. And where that's coming from is not only so look at this chart here and think last February was a level set. That was an average month. That's our baseline. We had a precipitous drop, right? We had massive reductions in open jobs and in availability of people to work while they were on furlough or had to be laid off. Not only have we seen a rally back, we have gone beyond typical to excess. I've seen some statistics saying that there are now more overall job openings than there ever have been before. That's a combination of factors, right? The number of jobs should increase as populations increase, especially as the available workforce gets larger. And we are now trying to both fill, jobs that had been vacant, plus we have new ventures. The big question here is going to be, how do we marry together available people and available jobs? Many people that are in the service type industry, maybe they can't go back to exactly what they did before. Maybe that venture isn't going to be exactly the style that it was before, the number of employees, et cetera. We need those folks to be able to find something else that they are able to do, retraining, things like that, their willingness to try something new. That will be a big factor in the ongoing success here.
Brian, given this demand for employment and kind of the glut of jobs that we're seeing right now, is there a lot of wage pressure in the economy at the moment?
We are absolutely seeing wage pressure. There's many inflationary pressures. We're going to talk about some of the specifics, but overall wage pressure is built by 2 things, right? So you have demand for people, you have increase in average work week. All right, the standard assumption many of us have is that people work 40 hours a week. That's not always the case, right? The average working week has been somewhere around 35 hours. That increases to about 36 hours. We eventually get back to 37 hours. 35 hours to 36 on an absolute level doesn't seem like that much, but that's a 3% increase. You're going to get paid for those extra hours. You also are going to have some compression there, or some increase, I should say, in the wage pressure on the idea that that there are going to be people in demand for very specific jobs that need that expertise that those folks have, especially in healthcare, which I did see a good note on this. By and large, the most available jobs that are posted today, keeping in mind that some of the service type jobs are still going to take a little while. Like, for example, Eric and I talked about Disneyland. Get ready, right? But they're going to have a big rollout coming, and that'll be a lot of jobs at once. But in the meanwhile, the health industry in general, which had its own rejiggering, call it, right, where certain things were open, maybe some other things had to be delayed. The number of openings in that field are massive, and that's an area where average wages are quite healthy already, could get even more. We are seeing wage pressure there, just so much on scarcity of qualified folks, and also the willingness to go out and pay a little extra for folks to come in, so you don't have to retrain and have them hit the ground running.
Thank you, Brian. We have another slide here on the normalization conversation. This is our last slide on the consumers. And all of these slides in total really are trying to paint a picture that the consumers are doing very well. A lot of people saved money over the last year because they weren't able to do things that now that they're vaccinated, or now that cases are down, they're able to do once again. Brian, how's that demonstrated on this chart that we're looking at here?
So there are 6 data points here, and I would break them into 2 sections. I promise I won't talk about all of them, but the first 2 on here are items that people could do from anywhere, right? We have purchase or readjustments to your mortgage situation. What's a good outcome of a drop in interest rates? Take advantage of that, right? I'm not getting much from my CDs, but I'm also able to cut my mortgage rates. So the first two are activity that was driven a lot by being at home for the case of consumer transactions and being able to take advantage of low rates for the mortgage transactions. Those started at a level set, again, just like some of the other slides, we're starting at a baseline level, big drop, rally back up. Well, we noticed those didn't drop nearly as much as the others, right? There was a kind of a pause and a catch my breath. What's my outcome going to be from this economic freeze? And then take advantage from there. For the last four, those are activity based on movement primarily. Excuse me. Let's look at hotel occupancy. We started at a level set of whatever was standard. We dropped by about 70%, right? So where there were 10 out of 10 hotel visitors, it became 3 out of 10. What have we seen since then? The actual completed transactions of people actually paying and staying is only down 15%. So out of that 10 people, 8.5 have come back and stayed. Looking forward, not only are we at that level, we're exceeding that level. We're seeing in some of the hotspots that are able to take on visitors, for example, like say Orlando, Miami, et cetera, even somewhat like Los Angeles, things like that. We're not only at where we were, and keep in mind, this is not compared to last year, because that's cherry picking, right? Anybody could beat last year. This is compared to 2 years ago, right? So even before any of this happened, we're at and starting to exceed those levels. And then the last one I would note is the last on the list, TSA traffic. This is, again, not pre-booked flights where we have seen significant upside already, and going forward, we'll see even more. This is completed going through the airport, standing in line. Anecdotal evidence here would be, when I was flying a few times last year, I get through a security line in 2 or 3 minutes. This time that I most recently did it, 25, 30 minutes, right? I've seen, some evidence there are lines that are actually going outside of the airport now due to, the distance protocols. But we're seeing these come back. These are great signs because we are a consumer-driven economy. 2/3, 70% is based on us and our choices. We need this to continue.
Yeah, Bryan, on TSA traffic, Alaska Airlines has a new CEO as of April 1st, and he announced that March was their first cash flow positive month since the pandemic began. So timing in life is everything. Delta Airlines also announced that in June they're expected to be cash flow positive. So the airlines are back. I think they would have preferred not to see this large dip that we've seen, but they've recovered and kind of made it to the other side of that chasm. One thing we've talked about, and I think this is one of my favorite conversations, is theater traffic and how many Americans are going to movies. What's that stat you shared with me on movie goers?
Yeah, this one is fascinating. So a year ago at this time, when I don't know where in the country anybody was actually going to a movie, some people managed to get in, and the box office receipts for an entire week were $5,000. Keep in mind, that's what you would usually get from a first run movie in a day, or less, half a day perhaps. This last week, this year, that number was about $40 million, which is still light by historical standards, but is hold on to this one, 800,000% increase year over year, right? So, of course, that's astronomical and that will not continue, but it just shows you not only are people willing and able, but they are doing it now, right? They're coming back. This is not something we need to anticipate going forward. We have a new baseline and we'll keep building off of that. But that number was incredible. Eric and I were saying, I don't know who got to go to a movie last year. Somehow a few people did. Now we're seeing that come back. That's a great harbinger for many levels. That it helps the media industry. It helps just on sort of the idea that people can go and do things that are normal. We're seeing it across the board in a lot of different areas.
All right, so with the first part of this presentation, again, we're talking about consumers and reopening, and I'm not sure we could be more optimistic about how the consumer's position and really how the reopening is going. Let's talk a little bit about policy now, and talk about what's happened over the past year and maybe how that influences our investments moving ahead. So on this chart, we see the money supply, and this is M2 money stock, which is cash plus electronic deposits. So it's not just physical dollars. And you can see really a pretty remarkable year that we've had. Bryan, what jumps out at you on this page?
So what this shows is an incredible situation demanded an incredible response, and we got that. And then now the question going forward will be how many more responses are responsible? So if you take this chart, and as Eric said, this is M2, this is sort of the classic Milton Friedman style of available cash. If I took that line as it existed all the way up until March of 2020, and I drew that out on about the same slope, we would be at about $16.5 trillion, right? The money supply grows over time. That is normal, right? If you ran this back further in history, that line does not change very much. When did it change? March, right? What we had for the first time really was a different response, a different reaction was to, instead of having monetary measures in other ways, we had those plus an increase in money supply. We went from what would have been otherwise 16.5 trillion on sort of a normalized slope to 19.5 trillion. That tells me, 19.7 officially, and it's probably even higher now. That means that there is $3 trillion out there to be used in some degree that wouldn't have been there otherwise, would not have been otherwise. What could be done with that? Well, you can pay down debt. You can make speculative stock purchases. Maybe you've heard about a few of those. You can use it to stockpile some cash, for like build up a bigger cash reserve. Historically speaking, when we had smaller versions of this, what would be done is a lot of times it would be used to buy treasuries. That's one of the responses. By increasing interest rates, you increase the coupon on treasuries or other instruments, but mostly treasuries, and those would get purchased, and that would help to mitigate this excess cash. Will that happen now? Not necessarily right now, given rates, but that's one of the big questions. What will be done? And maybe a lot of it is already being seen on the previous slide there. People are taking trips, people are buying things, people are getting ready to go out and do things. It's all of that, but we need to see is what is the impact of that and where does that money get allocated?
What jumps out to me on this slide, and I look at it in three different chunks. The first is the gradual upward slope up until March of last year. And then there was that very steep, very necessary influx of cash to kind of keep the economy alive last year. And then we have this period since. And what I take note of is that for the last year, the slope of the curve here is still steeper than it has been historically. So we're not back to that previous 2020 slope. We still have an increase in our money supply happening right as we speak. I think this next slide shows that in another way. This is the Fed's balance sheet. And Bryan, why don't you talk us through what's happening with the Fed's balance sheet?
Sure. Okay. So what we have here is I look at two different programs. We had QE, quantitative easing, 1, 2, and 3. Those were coming out of the financial crisis and were a response of trying to create liquidity and help kind of grease the wheels to keep everything moving forward. What I see there, if you look in the middle under treasuries where it has those numbers listed, if you add up all three of those numbers, it adds up to about $2 trillion for all three programs over about a 6-year period. This time, what we had was a massively bigger response, and it's done over a much more compressed time frame. The way that I would look at this is last time it was done in phases, kind of let's see what happens now, let's see what happens now. This time around was we cannot do this piecemeal. This is going to be done all at once, and it was done all at once. You have a combination here of treasuries, MBS, which is mortgage-backed securities. You have an increase in the balance sheet by the Fed, by the Federal Reserve. This is them acquiring bonds. This is keeping, kind of lubing the wheels once again, keeping things moving. The question now going forward will be, what do you do to try to unwind this? We were in a period of unwinding already. Now we're going to have to kind of reset that wheel again. But what you see is, that really big spike on the right-hand side, adding up to some numbers that we haven't seen before. And again, when you don't have a history to compare it to, the question is what's going to happen? Time will tell. We're going to see that play out.
Bryan, you mentioned unwinding, but actually, if you look at this chart, we're still doing the opposite of unwinding. The Fed is continuing QE4. There is no slowdown currently in the pace of purchases. And actually, the chairman of the Federal Reserve, Jerome Powell, has advocated continuing this policy at least for another couple of years. We're going to talk about that as we move more into inflation. But we have one more chart about fiscal policy in the federal government, because that's a big part of this conversation as well, of what's happening from a policy standpoint with the federal government.
Okay, so what we're looking at here is your classic, balance sheet, right? I have my spending on the left-hand side, and I have my where's that spending going to come from on the right-hand side. The big X factor here that did not exist before, get it back, there it is,
Yep.
is that brown box on the top left. That is the other, that is the stimulus. That is money that is being used to, so I think of it as, bridging the gap. We had a flow going, our $21 trillion GDP had a significant interruption. We had to, the tracks got broken. We had to maintain the tracks. How do we do that? With that other category. Where is that going to come from, right? When you have a $5 trillion budget become a $7 trillion budget, obviously that's a huge difference. Where is that going to come from? It's going to have to come from borrowing, right? It could eventually, to pay that back, will be things, taxes and various things that we all know about, but you can't do that immediately. What you can do more immediately is cover that with borrowing, with issuance of treasuries, for example. This number, that 3.4 trillion at the end of 2020, so 3 short months ago from the time of this chart, was 1.8 trillion. Then it became 3.4 trillion. It was a 36% of the budget, became a 50% of the budget. So the good news on that is we're doing this in a very low rate environment. The question mark out there is, how long will this be a very low rate environment, which is one of the themes of the presentation here, as the title says. Down at the bottom, I'll touch on a bit of this, and then Eric's going to jump in too. But down there, you're going to have your baseline assumptions, right? So all of this, CBO, the Congressional Budget Office, they report on the information that they are asked to use. The baseline here is a 10-year Treasury yield of 1. Right now, we're at about 1. Today, I saw we're actually down a bit, and we're at about 1.55. We were as high as 1.75. So there's a bit of a difference. Headline inflation, 1.7. The latest reading is 2.6. That just came out. So the point of that is, they're not going to always be right on these, but you have to compare the assumptions with the reality. That's how we're going to try to bring those two pieces together. But really what we're looking at here is we had a significant event. We acted on that event with about $2 trillion for this budget. And where did that come from? It came from borrowing. And then Eric, you want to add some color on that?
Yeah, one other thing I'd just like to talk through for everybody here on the bottom of the page is the difference between real GDP growth and nominal GDP growth. And real is the net of inflation. So nominal is the headline number that everybody hears that comes out of, it used to be the newspapers, but comes out online or on CNBC, is nominal GDP growth. And that's the number when we're saying, hey, we're going to have 6% GDP growth that you most often hear. Real is net of inflation. And inflation is really a wild card where, as you can see on this page, it's forecasted at 1.7%. But if we hit 2.6, which we recently did, or 3 or 4%, all of a sudden that eats away at your earnings and your portfolio returns, where you're needing greater returns in order to keep positive real returns. So keep in mind that term real and always understand if you're thinking about things in terms of a real or a nominal standpoint. Let's now move ahead away from fiscal policy and talk a little bit more about inflation specifically. Bryan, this is the business outlook hitting new highs. This is not news. It actually dovetails very nicely with what we were talking about with the consumer. Both consumers and businesses are feeling really good right now. But as we look on this next slide, the correlation between the business outlook and inflation has a pretty tight historical correlation, as you can see on this slide, Bryan.
It does indeed. So this goes back to 1997, 1996, 97. So we've had some peaks and valleys. We don't have on this the 1970s, early 80s style inflation. This is a different environment here. But here, what do we see? The dark blue is manufacturing. We're not a heavy manufacturing economy here, but it definitely is still a strong component of our overall picture. And what do we see here is it really dovetails with two things. It connects optimism about the economy and the increase in pricing, which is inflationary. So they don't go in lockstep. There are some places where there is a separation, but the theme of them does travel together. We see, when one drops, the other, when manufacturing drops, it tends to be deflationary and vice versa. We have seen an enormous rise, and I've just seen even more new stats today about the price of lumber, the price of steel, the price of used cars, all of these things that people are going for that are finite objects, right? I mean, why do you get inflation in general? Is you have a compression of demand of certain things, and then you have inflationary pressures for those, especially things like services, where there's not as much behind it about what brings those prices about. But basically, here what we're finding is the blue line is going up, and it's continuing to go up. The latest readings are even higher. Where will inflation go? And not only is inflation higher, yes, it already is. And inflation, just take one quick step back, inflation is not bad, right? Inflation is normal. You get a situation like Japan, which has been sort of stagnation, stagflation, they might call it. That is harder to dig yourselves out of. It's not that inflation on its own is a negative. It is whether it gets too overheated, the reaction to that, which is also very normal. That's one of the Fed's jobs. And also, the subject more of call it debate and discussion is how long will it stay at this elevated level? That's what we really need to know. And I'd say that's the one that has more separation of a viewpoint.
That's really the policy debate right now. It's fairly accepted, I think, on both sides of the inflation debate that we have higher inflation at the moment. The question is all the stimulus that we have, both from the federal government as well as from the Fed, necessary to dig us out of this structural hole that the pandemic put us in, and it just kind of gets us back to even? Or instead of building a bridge, is it more like building a freeway, and inflation will just continue to grow from this higher base that we now have? Both Janet Yellen and Jerome Powell, Janet Yellen, new Treasury Secretary, advocate that the first of those theories, that really all of this stimulus is helping get us to where we need for the economy to grow on its own. And then the market might be saying a different story, though. Let's look at this next chart. And the market, this is I mentioned earlier, Jerome Powell has stated the Fed doesn't want to raise interest rates till 2023. Well, if you look at the betting markets currently, there's telling a different story. In fact, this chart shows the probability of 2 Fed rate hikes next year. Not one. The probability for one is up around 90%, but the probability for 2 is well over 50%. And something has to give. Either this red dot on the top right of your screen is going to fall down to 0, or Jerome Powell is going to agree or change his mind and change course and begin to raise rates. What we're looking at for a first indicator of what the course of action might be is an end to QE4, because you won't see rates moving up until the Fed has really stopped their bond purchasing or reduced their bond purchasing. That would be step 1 of this process. And then step 2 would be to raise rates from 0% for the overnight rate where it currently sits today.
All I would add on that one is this marketplace tends to be very accurate. So, the Fed says one thing and they have their plots, and that's very important to know. This can change as well, right? I mean, it's not like this is going to continue to go up for perpetuity. We've already seen some drops on this in recent months and weeks, but watch this closely, as we, of course, will as well.
Well, and I will add to that point, Brian. I don't think you'll ever have a chairman of the Fed come out and say they expect inflation to go up in the future. The Fed has a dual mandate, and price stability is one of those mandates. The other is full employment. And so the balance between the two is really what the Fed is working toward. And the price stability, they're always going to talk toward price stability, because talking up inflation is not in the Fed's interest. But let's move on. It's a related conversation. We're talking about interest rates. Let's talk about bonds. And we're going to talk bonds for a few minutes and then end with an equity discussion. But here's what's going on in the bond market. In the blue line, we have the long treasury, 20 plus treasuries. And in the purple, we have the aggregate bond index, which is just kind of a generic broad bond index there. What are we looking at here, Brian?
So this is a fascinating view on risk and exposure in the bond market. The bond market tends to be thought of as sort of the sleepy, sibling to the stock market, but it has its own dynamics. Here in this time frame, from January of 2020 until a couple of weeks ago, what this is telling me is that for all of 2020, and especially after the lockdown, after the procedures were put into place, and we had to make some cuts to interest rates, What happened? All of a sudden, owning a long bond looked like a good bet. And why would I do that? I'll just quickly say, if I think that my 4% coupon is going to be price competitive, coupon competitive for 20 years, it looks like a great bet. If I think it's only going to be price competitive for about 2 years, I'm going to start to hedge a little bit and not be so excited about it. This shows me that up until about August or maybe September, the very specific bet was long bonds are the way to go. Think about this, a 3 or 4% coupon gave you about a 24 to 26% total return. That's crazy, right? And we saw just how crazy that is when we started to see some vaccine news, we started to see some reopenings, we started to get the light towards the tunnel was still pretty far then, but we could see some light. Immediately, almost immediately, you get a sharp drop in total return. What this tells me is that duration, the length of time to get paid out for a bond, exposure has significant risks, right? If you look at that purple line, that holding has a lot of treasuries, but they're not 20 plus year exclusively treasuries. That risk exists even in treasuries. Treasuries are safe. Well, yes, but not if you're looking at them as a total return vehicle that's going to be rivaling, more aggressive stocks. That's not what they're for. This is an example of getting caught upside down to the point where not only did someone who held this position that long lose out their return, they ended up under having a much shorter, much broader bond index. This is showing me that bond risk is real and people got caught upside down on it.
So long-term treasuries obviously have had a pretty big sell-off. What is that? Down over 20% from the peak. Let's talk a little bit about corporates and what are you seeing out there in the corporate bond market?
Okay, so there's a lot of information here. I'm going to look at each of them on their own. On the left-hand side, that big spike up in that gray line, that's the increase in treasuries. There's as we've seen on some other charts already, we've talked about, there's been a massive increase in the volume of treasuries and at pretty low interest rates. That's going to make those seem not super price competitive. We have seen, to no surprise, a sell-off on that side of things, and those aren't looking quite so attractive. Okay, well, what do we see and what does the marketplace see as an alternative to that? The right-hand side is two different aspects of looking at the corporate bond world. So this is not treasuries, it's not mortgage backs. This is companies issuing debt. For example, even Apple issues debt. Why? Because it's super low yield. They don't have to pay a lot for it, and it gives them some easy cash flow. Not bad. But this top right-hand corner shows us that the world of corporate bonds is different now than it has been in the past. Triple B, or in this case, BAA, which is the same thing, that's the lowest level of investment grade bonds. That aspect of the marketplace is increasing. I'd say there's two different reasons for that. The first one is the rating agencies, pretty rightfully so, got a little bit of a slap on the wrist about 10, 15 years ago for being too lax in their rating structure. So what happens, right? If you're overly lax, maybe you get a little overly harsh and eventually you sort of, even out. But right now there's some of that. But a bigger part of it is if I'm a moderately good credit company and 10 years ago, 15 years ago, I had to issue bonds with a 5% coupon or a 7 even, or an 8, and now I can do it with a 3 or a 4, I'm like, I can afford that, right? My default risk is pretty low, it's very low, really. And I am now able to enter this marketplace when before I had to self-select my way out of it. That has added a lot more players to that world. It has added pieces that are actually, relatively speaking, attractive. And that is where, one of those places that we've looked at as well. The bottom right shows me that the investment grade universe, the duration, and again, I use that term, what does it mean? The length of time to get paid out. If it takes me longer to get paid out, there's more chance of a default. There's more chance of other options looking more attractive. I don't necessarily like having longer duration, and especially not when my average, you see in the dotted line, is just over 6 years, and now I'm at 8.5. That means it has gone up by about 40%, 35, 40%. I don't like that very much. So we talk internally that there are two core aspects. There's credit risk, there's duration risk. Right now, for us, for the whole time I've been here, and I believe this will stay going forward, we would prefer modest, reasonable credit risk over duration risk. Why? That last slide showed me why. Duration is out of my control. If I start to see a sell-off, I can see it drop dramatically quickly. This gives me more control.
So to put that in other terms, we would prefer corporate bonds or I guess lower credits to treasuries. And we'd also prefer shorter term bonds to longer term. And this next chart, I think, shows a little bit why this is where we see some opportunities out there. It's a little bit wonky, but Bryan, why don't you boil it down for us and tell us what we're looking at?
Who doesn't love a busy slide full of plot points, right, to talk about bonds? Well, let's isolate two columns here. The very left-hand side is treasuries. The very right-hand side is mortgage-backed. What's the similarity between those? They're both issued by government agencies, right? They're both very, very safe, but one of them is thought of as sort of the default option in bonds. That's treasuries. One of them is not thought of quite so specifically that way. That's mortgage-backed. Here, the biggest thing to look at is that blue dot. I know for some of you, especially on a smaller screen, it might be hard to see. I'm going to tell you what it is. The blue dot for treasuries is the yield per unit of deviation, of risk, of volatility. In treasuries, it is the lowest by far of any class on here. It's 0.22% yield, excuse me, 0.1% of yield per unit of duration, or of volatility. That's not good, right? Not only is it not good, it's horrible compared to everything else on this screen. What looks really good by comparison? Mortgage backs, 0.88, 4 times, literally 4 times the yield per unit of risk for going to something that is not that different in its credit quality, in its worthiness, let's call it. That shows me overall big picture is people are way too dependent on treasuries. There needs to be kind of a rejiggering of thought to not default to treasuries so often. And every single other category on here, which I promise I won't go through all of them, every single one of them is better by this very simple measure than a treasury. We need to expand our thought. And just like Erich said before, what we do try to emphasize, this is why, right? Treasuries are not worth the price they're being paid for. How do we see that? The big sell-off in treasuries that we have seen over the last multiple months.
So I'm going to summarize the bond conversation, which is to say there's definitely some risks out there with bonds. We saw that with that TLT chart, but there's also some opportunities in how you can position your portfolio, both for a rising rate environment and this kind of structure of the issuance of treasuries and kind of the treasury market just being so big and where it is today. That's not too different from the equity conversation. There are some risks in equities for sure, but we believe you can position your equity portfolio around those risks appropriately. In this next chart, we'll talk about the S&P and talk about equities. And this is just a performance chart for the last 25 years of the S&P 500 index with some data points along the way. And this has been a great start to 2021 after what was a great year in 2020. And given all that has happened in the economy, I think it's really remarkable to see stocks rally to where they have rallied today. But that optimism that we saw from the consumer, the balance sheet of the consumer is flowing through into equities, flowing through into economic growth. And the question is, will that growth justify today's valuation? We see here on the top right of the screen, the forward price to earnings ratio of the S&P 500 currently sits around 22. That's put quite frankly, that is very high. If you look back over the last 25 years, when have we seen a number at least that high? Really only one time, and that is right at the peak of the tech bubble where stocks were priced at 27 times earnings. The difference today is that interest rates back then were not as low as they were today. You can see that in the chart here in the middle of your screen. Interest rates, the 10-year treasury was at 6.2% back in March of 2000, whereas today it's more like 1.5%. So in 2000, if you thought stocks were expensive, you would sell your stocks and you'd buy 10-year treasury and you'd make your 6% and feel very good about that. Today, you could sell your equities and go buy a bond, but you might not feel so good about that. So that's one thing that is different is the interest rate regime. The other is the GDP growth and the earnings growth behind today's valuation. And when we see earnings or the economy growing at 6%, this 22 times forward earnings doesn't seem quite as outlandish as it might be if you just looked at this chart without any other information. What we are focused on right now is what has been a rotation out of growth stocks into value stocks. Really, since the November election, we've seen value outperform growth. Not as strongly of late, but still that trend remains intact. And at Cutler, we have a a value bias in our portfolios because we like the lower risk profile of value type stocks. Value stocks are, they're generally slower growing, but they pay dividends. They have strong cash flows. They're more brick and mortar types of businesses. When you see an infrastructure bill being rolled out by the federal government, that type of policy definitely favors those brick and mortar types of businesses. So we think that that rotation does have legs. The question then is, should you abandon growth stocks? And my answer to that is no, you should not abandon growth stocks. What you should do is you should look for profitable companies, whether they're growth stocks or value stocks, and invest there. What we have seen is some speculative elements creeping into the market, especially when consumers are given a $1,400 check and they can go open a Robinhood account and start buying stocks with it. In that scenario, a lot of retail investors are buying companies that may not have the profitability that some of these more established companies do. So whether it's growth or value, I think profitability is the key as you move forward, and really the ability to grow those earnings at a steady clip is something we're focused on at Cutler. Let's talk a little bit about what has done well thus far this year in the first quarter. This is a first quarter recap. So Bryan, when you're looking at the first quarter, what do you think of?
So when I look at this chart here, this has, there's 11 sectors, it's 11 core sectors, and then there are some subsectors. So this is a mix of some of both of those. But basically what happened last year was we were in the lockdown trade. We were in the, people aren't going to go on airlines, aren't going to go to shopping malls trade, which looked like at that time, again, like I noted before, we did not know what the duration of that lockdown scenario was going to be. We got to the point, for example, for airlines where they were priced as though 3 out of every 10 typical clients, flyers, was going to be on an airplane in the next few years. We have already noted that not only are we not there, we're going to potentially exceed what used to be a typical number of flyers for a given year. So this trade, once again, related to vaccines and reopenings and that big bright light at the end of the tunnel, has had a massive swing back the other way. We've seen on the flip side, online retail had enormous gains last year on a broad spectrum of holdings. They've given back a little bit of that, mostly just because the valuations have gotten to the point of being ludicrous. So you had some normalization there. You had rally back in some of the areas that looked like they were dead and gone. One last note I'll make on this: if you look at the S&P 500 down towards that sort of lower middle, it made money in both of those environments, right? When you have a broadly diversified holding there that can take advantage of some of either one of those dynamics, there we go, right? I mean, hyper-specific trades can work for a while. They can really get crushed for a while, but the broad index here made money in both of those environments. It's just the way that it came about those gains was quite different. That's one of the nice parts of being diversified, is you don't get too far down or too far up even, because that can lead to too far down. That's what we saw.
All right, so we'll end with diversification and really talking about investment discipline, because I think especially with regard to the bond conversation, it's easy to get kind of negative and to think, well, why should I own any bonds in my portfolio? You can see they're down 3% thus far this year, but really over the last 15 years of this chart that we're all looking at today, bonds were only down one other year in the last 15. So bonds still do play an important role for an investor's portfolio of stability, of income, of kind of creating that safety net when equity prices do come down. In the meantime, equities are going to be your growth portion of your portfolio. That's always been the case, and it will be today. You can see the stock market's been led higher by small cap stocks. Small cap stocks struggled a little bit over the last few years relative to large cap stocks, but they're really having a good run this year. Part of that is a lower interest rate regime also benefits those small cap companies. And you can see this year, large value stocks outperforming the S&P. They're up 11% through March 31st, whereas the S&P 500 at that point in time was up 6. It has rallied into April. We've seen more of a risk on trade in April, and investors flooding back into the stock market. Equities have done quite well, and we're positioning portfolios for how we see and kind of in line with these these thoughts that we've shared with you here today. So maintain your discipline, stay in a diversified portfolio, and if you have any questions, feel free to call Bryan or myself or Matt as well. We're happy to answer any investment related question or any portfolio related question you might have about what we spoke about today.
All right. Thank you, guys. Appreciate your thoughts. And just to reiterate Erich's point, while the rest of us are available, your advisor is obviously a great resource to talk about some of these points. Make sure you understand them and provide any clarity you might have as well. Finally, just to reiterate what we said at the beginning, this will be posted to our website later today. Feel free to share it with anybody you might find appropriate. And we appreciate your attention today. Thank you for joining us. We look forward to talking to you in just a short 3 months to see how these guys did on their procrastination. So thank you, guys. We appreciate it and have a great day.
Thank you, everybody, for joining us.